Sticking with retail for our ETF Spotlight, we're taking a look at the XRT today, down 8% for the month, trading slightly higher today ahead of what Sarah said would be a busy week for retail earnings. Macy's, Nordstrom, TJ Maxx, Kohl's, Target among the names on deck to report results. Joining us to discuss, SW Retail Advisors President Stacey Widlitz is with us. Stacey, good to have you back. Good morning.
Good to see you.
How much does last week's retail sales number give you confidence that the consumer is going to hang in there?
Well, I think what we've learned is that the consumer is definitely hanging in there. But as we've talked about for the past couple of years, there are the have-nots. There are the retailers that are driving traffic. That's Target, Walmart, TJX, Ulta. You were just talking about cosmetics with Estee Lauder and the selfie generation. And then, of course, there are the department stores and the specialty retailers that really have a lot of self-inflicted pain here. But the consumers remain strong. Clearly, there are increased signs of potential issues ahead, but for now, the numbers look good.
I saw some numbers this is pretty geographically specific, New York tourism, right? Even as we hear concerns about the drop in, for example, the number of Chinese visitors to the United States. How much do the Signets and the Tiffany's rely on foreign customers?
That is a huge part of the business, and it's a very important part of the business. You know, Tiffany last quarter said that the Chinese visitors dropped 25%. That's an incredible number for them. And, you know, they used to say the flagship store in New York, tourism was up to 40% of that business. So it's so important. And as you see, the Chinese, A, have less spending power because of their currency. B, are staying home and repatriating luxury spend, you know, and of course, certainly third, the American brands, questionable if there'll be some retaliation. Some of these North American luxury brands are under significant pressure here. You know, Tiffany's one example, and certainly you have TPR and CPRI, Capri and Tapestry that are also suffering from declines in the wholesale space.
Tapestry is down 38% so far this year. And then you've got restaurants like Chipotle up 88%, Starbucks up 49%. I mean, there's such a strong bifurcation going on in the market, Stacey, around some of these consumer names. Do you buy the ones that have been beat up because they look cheap, or stick with the winners?
Sarah, I think here's what happened. Over the past couple years, we've seen the brands, whether it's Under Armour or retailers like Kohl's and Macy's, clean up the channel and say, listen, we're not going to promote anymore. We're going to clean up margins. And they did that, but they did not drive their sales through volume or traffic. They drove it through price points. That is over. That is behind us. And these companies have failed to pick up where they left off and increase volume. So we don't have any same-store sales growth in so many of these names. And when you talk about a Capri or a Tapestry, Coach and Kors, they have made acquisitions. What I like to say is the look over here strategy. Don't look at our core brand, and said, hey, we can turn around these brands. So far, that is not working. So I would stay away from these stocks. Certainly, Tapestry bought back stock last quarter and is already down 30% on that buyback purchase. So, you know, you have to kind of question the direction here.
Stacey, what do you make of Macy's? You mentioned it, obviously, and the stock took a significant hit after earnings. But you look at it with a 9.4% dividend yield, and you have to imagine some people are tempted to try to wade into those shares, just given if the dividend hangs in there.
David, that's a good point. And you look at so many of these retail stocks, you know, Kohl's is yielding 6%, and it's so tempting to say, hey, let's jump in here. But of course, that yield suggests there is more risk to come, and there, I think, is more risk to come here. Certainly, Macy's, you look at their margin structure continues to come down. They continue to be forced to offer more freebies here. So the operating margins continue to come down in that sector. And, you know, there's no end in sight. We talked about Estee Lauder. You look at Ulta Cosmetics. They are stealing traffic from that all-important beauty-driving sector out of the department stores. So I would continue to avoid them. It's like catching a falling knife here.
All right, so Stacey, finally, of the big guys this week, Depot, TJX, Target, I mean, who really needs to knock it out of the park, if anybody?
Well, I think Target, there's high expectations here. You know, they talked about their new private label grocery brand here, which is so important. They are really driving traffic through private labels. The expectation there is that, you know, their comps will continue to be driven through traffic. I have confidence that they will because of what they're doing in private label. But certainly, you know, they need to do well here. Walmart certainly set the bar. And of course, TJX that have been driving comps all through traffic as well. You know, the high expectations there. But again, that's where the traffic is going. So I would continue to own those stocks. And I would mention that Target at 14 times is incredibly cheap versus Walmart here.